All right, welcome back to the Know Your Numbers REI podcast. Chris McCormack, CPA, certified tax planner, here with you. We created this channel, these podcasts, this YouTube videos to get in the ears and eyes of more people who need it. Those who are frustrated, those who are confused, those who are stressed out about taxes and bookkeeping and accounting. So if that's you and you don't have a tax planner or a CPA or somebody in your corner that has a relationship with you, communicates with you, then we'd love to hear from you. We'd love to get on your calendar, have you get on our calendar, see if it's a good fit to work with us. If you know somebody that's like that, do us a favor and share the show. Share it with friends, family, entrepreneurs, investors. We really want, and we've seen this pay off for so many people. We've seen people move forward in tax plans because they started with this and now they have so much more money and freedom and peace of mind and confidence as a result. So please do us a favor and share this episode if you think it's worthwhile. Today, we're going to be talking about how rental properties can actually be your ultimate tax shelter, right? We talk about rental properties. We talk about some of the things like cost segregation, 1031 exchanges, using rental properties to offset income or to save on tax. But what if I told you that rental properties can actually be one of the best tax shelters out there? You don't have to create some complex trust. Don't have to create a line of 5 different entities that do 5 different things that you don't even know about. No, it can be right in your backyard with the rental properties, okay? They offer a multitude of ways to legally reduce your taxable income and to defer taxes. Today's episode, we're going to be unpacking this. We're going to be talking about ways to shelter your income through rental properties. They can shield your income from taxes. I'll explain how depreciation, certain deductions, tax strategies can work together in unity to turn your real estate portfolio into a powerful tax-saving, wealth-building machine. You're a real estate investor, or maybe you're thinking about real estate, you're probably familiar with how high taxes can eat into your profits, right? It's something that we all don't understand. When we hear and listen and read about real estate, we've been told, yeah, you pay no taxes. And then you're getting into real estate and you're quickly finding out that no, you do pay taxes. If you're showing a profit, then you're going to pay taxes on it and it's going to eat away at that profit. Because again, profit excludes your mortgage principal. So that's money that you're paying that you're not getting deducted. And then there's so many other things that come into play. But today we're going to be talking about the deductions, the deferrals, and the minor changes that you can do as a real estate investor to make this a tax shelter, to hide your income legally and ethically. It's not even hiding it, it's just using what they have put forth for you. Okay, so you're probably dealing with high taxes, or you're just wondering if you could be paying less in taxes. It might feel like an insurmountable obstacle. All right, I say this because I meet with you guys. I know the pain that it causes you. You take on a lot of debt, you use leverage for what you think is a good asset, and then you find out that you have to pay thousands and thousands of dollars in taxes on top of it. And then some of you are going into even more debt just because you have to get on a payment plan. It doesn't have to be like that, okay? We work with many investors who have high paychecks, and so their taxes are very high, okay? You invest in rental properties hoping that everything you've heard or read or listened to is true, and that just buying a rental property is going to decrease your taxes. And then you find out in April or in October, if you extend, that is not the case. You're paying more in taxes because you're making more money. Okay, you start to wonder, is this even worth it? It's crazy, and I understand how you feel. We have one client, David, we'll call him. He had been investing in rental properties for a few years. He was still struggling with high taxes on his rental and business income. He was making over $500,000 in his W-2 and was also getting profit shares in K-1s through that as well. We took a closer look at his properties, his portfolio, and realized that with a few shifts, he could be making better use of the rental properties and some of the other passive investments that he had. And so in year one, what was a $20,000 tax bill when he first came to us ended up being a $30,000 refund. That's $50,000 in year one. Since then, he's been working with us for 2 more years, and we've been able to save him. We saved him in 2023 about $25,000 in taxes, and we'll be doing the same, probably more than that, $30,000 in taxes in 2024. Just by a few shifts, using real estate and some other opportunities to shelter some income legally and ethically. And it's possible for you too. Okay, we had another client. We'll call him Charlie, if you will. He came to us with what was a $90,000 tax bill. He had worked with an accountant. They weren't doing anything for him. He was stressed out because he had his highest income year, and he also owned rental properties, commercial properties. And so he met with us, and I looked at his stuff, and I realized, dude, you could be eliminating $90,000 in taxes if you just do a few things, if you use your rental properties to the best of your ability. So in year one, he hired us, and what was a $90,000 tax bill came down to zero. He did pay a little tax on self-employment taxes because we weren't able to do anything on the entity structure just yet, but that went away the next year. So it was $90,000, came back down, and then even next year we were able to do a lot more. So without utilizing these strategies, both David and Charlie would be losing money. David would not have $50,000 that he now has, and Charlie would not have the $90,000 and then some That's $140,000 between the two that we were able to do. And we didn't do much with the rental properties. Here are some of the few things that you can do. Depreciation is literally a shield against taxes. You don't have to do anything for it. It's something that is given to you if you do it the proper way. Okay, and most people do straight line depreciation, which offers some benefits, but it's not all the benefit. So you have to make sure that you're maximizing depreciation. For those of you that don't know, depreciation is what we call a phantom expense. You don't have to pay for it. You buy the property. A lot of times you use debt to finance the property, and yet the IRS is going to allow you to depreciate the entire value of the property over a certain amount of time. And yet that property is going up in value and it's cash flowing. But you can show that it's not cash flowing through the use of depreciation. And this strategy, along with many others, is why guys like David and Charlie are able to save on tax, get refunds when they're used to paying in. We then can use something like cost segregation to accelerate the depreciation, right? So instead of depreciating it over 27 and a half or 39 years, you can break it out into 5, 7, 15, and 27 years. And that way, what was getting depreciated evenly over the 27 years is now getting depreciated in greater amounts in year 1, 2, 3, and then it starts to go down a little bit. But because we're saving so much in the early years, we can reinvest that and get more properties and then cost segregate those too. So you're getting depreciation and you're increasing the amount of depreciation through the use of cost segregation. Those two will work wonders on your properties and your profits and your cash flow if it is qualified for you, if you qualify, if it's something that meets your needs, right? So don't go out and go get a cost segregation. Meet with a tax professional. Meet with a CPA who's qualified, who knows what real estate is and knows what cost segregation is and knows how to incorporate it according to your goals, right? Because not everybody needs cost segregation. We've done episodes on 1031 exchange and cost segregation and how cost segregation can lead to unnecessary tax consequences when you go and sell. So that's why you need somebody who is relatable and knows your situation, knows what you want to achieve, so that they can say, hey, get cost segregation on this property, or no, not that property, we're selling it in 2 years. Get it on this property so that we can see it for the long haul, right? So you got depreciation, you got cost segregation. The next one is mortgage interest deduction, okay? It's a pretty familiar one. It's not gonna make a large difference, but you would be surprised at how many people aren't recording it on their profit and loss, because oftentimes, like, you wait till you get your 1098, the interest form, before it's recorded, and at that point, maybe your accountant took what was in the software and it didn't include the interest deduction or included all the principal, and so they weren't sure, and because they didn't communicate or they had too many clients, like, things got missed. So I'm not saying that this is happening every time, but mortgage interest deduction is a huge benefit, right? You're paying a lot of money to the banks who are giving you the ability to buy this property. You might as well get the write-off that you can when it comes to mortgage interest, all right? Let's just say you make $30,000 in income and you paid $15,000 in interest. Your taxable income comes down to $15,000. And then you can think about things like utilities or repairs or depreciation, and that $15,000 starts to go down a lot more, right? People see that they made $30,000 and they're like, oh my goodness, I'm gonna have to pay taxes. 25% of $30,000 is $7,500. Nobody wants a $7,000, $8,000 tax bill on their real estate portfolio. So we use interest to bring it down. And then we use other deductions that are available to us, like repairs and maintenance. Okay, there's a difference between improvements and repairs. Costs related to repairs, renovation, general upkeep of your properties are deductible. But things like replacing a roof might need to be capitalized, which leads to a depreciation deduction. You don't want to miss out on that. Okay, you don't want to miss out on the depreciation. So when you capitalize an expense, when you have to classify it as an improvement according to the Internal Revenue Code, you're going to want to make sure that it's done according to the year that the Internal Revenue Code lays it out. You're not going to want a 5-year property being capitalized and depreciated over 27 years, right? This is like cost segregation, except you don't have to do the big engineering studies because you know that you purchased a water cooler or a water heater or an HVAC unit. Like, those things, if they have to be capitalized, they have different depreciable lives compared to, say, a roof or the entire building. And so repairs get expensed immediately. Things that are improved get depreciated, but both of those can have great impact on your tax bill. It can lower your tax bill if you do it strategically. So you're going to want to make sure that you do. And then you can defer tax. Can do things like 1031 exchanges that can defer taxes. Some people say 1031 until you die. You buy a property, you sell the property, roll it into a 1031 exchange, buy another property, rinse and repeat over and over and over again. And then you're at the age of 80, you're thinking about what's next. You're not going to go sell your properties. You're going to leave them to your heirs so that they can inherit them and receive a step up in basis. It's one of the greatest tax strategies available. And it's also only for people who that's their goal. If that's not your goal, then you don't have to do it. but understand that you can defer taxes, right? If you have a $300,000, that's 20% of that, which is a capital gains tax rate. 20% is $60,000. So that 300 quickly comes down to 240, and then you have fees and costs of selling and different things. You have mortgages that you got to pay down. Like, there's a lot that goes into that. But if you can take that 300,000, park it into a better property that's cash flowing more, maybe has more units, then you defer the taxes and you don't have to worry about it. And now you have equity in this new property that you can tap into if you want to. So there's depreciation, there's accelerated depreciation through cost segregation, there's mortgage interest deduction, there's repairs and improvements, and there's tax deferred growth. These are just a few ways that you can shelter cash through the power of real estate, right? And these are all legal. I'm not telling you to do something that's completely foreign to us here. These are simple tips and tricks that you can use if you qualify, if you're eligible, if it makes sense. So be sure to meet with a tax planner. All right. So some common misconceptions when it comes to rental properties are that they're too complicated or risky when it comes to taxes. People hear about some of these things like depreciation, cost segregation, 1031 exchange, repairs and improvements, and they're like, I don't know if I want to get into that. I don't know. That sounds a little fishy for whatever reason, but it's totally there. It's right there in the book. So the only reason that you wouldn't want to do this to shelter your income using phantom expenses like depreciation is because you're very risk averse, a little too conservative, and you don't know the law. And that happens year after year to too many Americans. There's too many CPAs that just don't know what they're doing when it comes to real estate, or they don't have the time to communicate with their clients to hear, what did you do with this property? Is this a rental? How much did you put into it? Are you living in part of it? Like, those are questions that you need to know if you're working with someone, and they need to know. Some other concerns come when you think about cost segregation, and it happens when you go to sell and people think that because you depreciated so much, you might be on the hook for more taxes. And that is the case. But if you pair this and you plan with a tax planner and you guys are working together to eliminate taxes overall, then you can plan for it and use something like a 1031 exchange to defer taxes or other strategies that are available to you. There's so many other strategies that are a little bit more complex, but they're totally available for the right people. And so if that's you, or if these are concerns that you have, please reach out to a qualified tax professional, somebody who knows what they're doing. All right, so your next step, I want you to look at your rental property portfolio and ask yourself, are you fully leveraging depreciation? Are you thinking about selling properties? And if so, do you have a plan to mitigate taxes? Are you deducting interest? Or are you just waiting for that 1098 and hoping that the CPA hasn't prepared your taxes before you got that form or submitted that form? Or maybe you forgot to submit that form. Are you capitalizing improvements or deducting repairs? Or are you doing the opposite and wasting money because you're capitalizing everything and depreciating it over 27 years, right? These are questions that I want you to ask. And if you're unsure about what the answer is, then please reach out to a qualified professional. Reach out to a tax planner. Sit down with a real estate tax expert who can help turn your properties into the tax shelters that they can be, right? I always refer you back to the 4 pillars of a good rental property: appreciation, cash flow, leverage, tax benefits. We're covering the tax benefits today. All right. Rental properties aren't just a passive activity. They can be used to grow your wealth, to reinvest, right? You can save money on taxes, take that money, park it into another property, and continue to build wealth. People are doing this on a regular basis. Too many people are missing out. So I encourage you to check out your portfolio, see what you're missing out on. If you are lacking confidence in the tax benefits that you're receiving, reach out to us. We'd love to hear from you. We'd love to see if it's a good fit, but use this week as we prepare for tax returns to be prepared and consider what needs to change for 2025. Use it to evaluate your portfolio and see what's going on, to see if you can really do better in sheltering your income through the power of real estate. Until next time, God bless you and keep moving forward.